To keep yourself updated, subscribe to Indigolearn and click the bell icon.
Hi friends, let us now understand joint venture and the accounting aspects related to joint venture. Now before we move on to understand what are the accounting aspects, we must be absolutely clear about what is a joint venture. Now if you look at the name joint and venture, the name itself indicates something. Joint means it involves two or more parties. Whenever there is a joint venture, there are at least two parties to the venture. And what is this venture all about? Venture is nothing but a business or an enterprise or a commercial activity which these parties have agreed to undertake. So what is a joint venture? It is an agreement or it is an arrangement between two or more parties to carry out certain business or commercial activity. Now where are these joint ventures used? Now, joint ventures are generally used where there is a huge amount of capital investment. So, if you look at construction of metro rail, if you look at construction of highways, there are a lot of cases where joint ventures are used. For example, the metro rail in Mumbai, it is a joint venture between Reliance, MMRDA and one more company. If you look at Delhi International Airport, such a huge airport construction, such a huge airport operations and maintenance, it is a joint venture between GMR, Airport Authorities of India and Fraport. So these three companies have come together, they have formed a joint venture, they have constructed and now they are operating the airport. So whenever there are large constructions involved, construction of building, constructions of bridges, dams, you can see joint ventures between two or more companies. Also, when you look at exploration and mining sector, whenever there is oil exploration, two or three oil companies come together, they form a joint venture and then they carry out the exploration activity, means finding oil, bringing the oil to the surface and then selling those oil. If you look at the coal mining sector, even there you can see joint venture. You can see joint venture even at a smaller level. For example, there are two traders, one is situated in the eastern part, one is situated in the western part. If the person in the western part wants to supply or sell something in the eastern part, these two people can come together and they can form a joint venture. The person in the western part, he will supply the material. The person in the eastern part, he will sell the material. Sometimes when there are advanced technologies involved, especially when we need to rely on foreign partners, even there we can see joint ventures. For example, you want to construct bullet train. I'm just giving you an example. You want to construct a bullet train in India. Now in India, there can be one company which has the capacity, which has the money to construct the railways or construct the bullet trains, and the government has permitted this company to construct the bullet train. But this company does not have the technology. What can be done in that case? You can enter into an agreement with a foreign company which has the technology. So the foreign company will give the technology. This Indian company will take care of the construction activity. This joint venture can actually construct the bullet train. In fact, they can also operate the bullet train. A lot of insurance companies you see around, even they are cases of joint ventures. For example, Bharati AXA. So there is one Indian company, Bharati, and then we have AXA Insurance. Both have come together and they have formed a joint venture. So joint venture is nothing but a kind of partnership for a specific purpose. If you go back to your partnership accounting or whatever you have learned in the partnership theory, partnership is all about two or more parties coming together to do a commercial activity or to do a business activity. But in case of a partnership, it is not that partnership exists for a specific purpose. Except for a particular partnership, all other partnership are general partnership. There is no specific or one single objective for which partnership exists. They'll keep on continuing doing the business. But when it comes to joint venture, they are formed for a specific purpose. If it is a construction of bridge, after the construction of the bridge, the joint venture comes to an end. If you look at any other thing, if you look at the Delhi International Airport, the joint venture is to construct and operate the airport for a specified number of years, after which the joint venture comes to an end. Similarly, if it is about oil exploration, after the exploration activities are completed, after the production activities are completed, the joint venture comes to an end. So what is a joint venture? It is a venture between two or more parties who have come together to carry out a specific business or a specific commercial activity. After that specific activity is over, after that particular activity is completed, or after the objective have been achieved, the venture comes to an end. So this is a brief background of what a joint venture is. Now you may wonder, isn't it the same like partnership? Yes, in many sense, joint venture looks like a partnership. Even in partnership, we have 2 or more people coming in and doing business. Even in a joint venture, we have 2 or more parties coming together and doing a business. Even in partnership, the objective was to do a commercial activity, earn profits and share the profits. Same is the case with joint venture. Because they are doing a commercial activity, they want to earn profits and they want to share those profits. So if you look at the structure, joint venture and partnership looks similar, but there are some differences. One of the fundamental difference being partnership is governed by the Partnership Act of 1932, but joint venture, there is no such act which governs the joint venture. Also, if you look at the partnership, you will prepare accounts on a yearly basis and you will share the profits, you will provide interest on drawings and capital. That activity is done on an annual basis. But when you come to a joint venture, the computation of profit and all the distribution of profit part of it is generally done at the time of completion of the venture. It is not done on a periodic basis. Partnership can continue for multiple purposes. It is not that it exists for a specific purpose except a particular partnership, but when it comes to a joint venture, it exists only for a specific purpose. Once the specific purpose is achieved, once the activity is completed, the joint venture comes to an end. In case of a partnership, the parties which are involved in the business are called partners. In case of a joint venture, they are called co-venturers. When it comes to a partnership, generally you have a separate business name or a separate firm name. In case of a joint venture, you may have a firm name or you may have a separate venture name, or you need not have a separate venture name. That is also possible. When it comes to partnership, because it's a separate firm, it is a separate business entity which is created, the books of accounts are maintained separately. So the partnership will have its own set of accounts, the partners will have their respective accounts separately. But when it comes to a joint venture, it is not necessary that you have separate books of account. In some cases, the joint venture does not maintain account at all. Only the co-venturers will maintain the accounts. Also, in case of a partnership, generally the partners can be restricted to carry out competing business. For example, A, B and C are in a partnership of a restaurant business. A, B and C may not be allowed to carry out a private restaurant business separately from that of the firm. But when it comes to joint venture, generally such restrictions are not seen. So in these senses, a partnership is different from a joint venture. But again, a joint venture is an arrangement between 2 or more parties to carry out a specific business or a specific commercial activity. And once that activity is completed, the joint venture comes to an end. So to summarize the characteristics of a joint venture, the first one is, it's a specific duration, specific purpose partnership. So either it can be for a specific duration or a specific purpose. It is like partnership, but it is not treated or it is not accounted as partnership. The second characteristic is, it involves 2 or more parties. So 2 or more parties come in and they start a joint venture. These parties are called co-venturers. And the third part is, they have an agreement amongst themselves. So how do we run the business? How do we control the business? Everything is governed by the agreement between these co-venturers. Like in the case of partnership, we have a partnership deed. Here we will have an agreement between the co-venturers. The next feature is, the joint venture may not have a name. So it is not necessary that the joint venture has a separate name. The profit or loss coming out of the joint venture is shared amongst the co-venturers according to the terms of the agreement. There may not be a restriction on the joint venturers to carry out a competing business. And generally, the profit or loss of the venture is computed on the completion of the venture. So unless it's a very long joint venture, let's say a joint venture to construct and operate an airport, which may be a 30-year contract, in such cases, you may have annual computation of profit or loss, but otherwise, generally, it is done at the end of the venture. Having understood the meaning of a joint venture, let us understand the different types of joint ventures which can exist. So there are 3 broad categories of joint ventures which generally exist. The first one is a jointly controlled operation. The second one is a jointly controlled asset. And the third one is jointly controlled entity. Now see the term jointly controlled, that is common in all these 3 categories. We'll understand what this joint control is and what is joint controlling of operations, assets and entities. For this, let us take a small example. Say there is one Mr. A who owns a parcel of land. He has a land at a very premium location of a city. So Mr. A has land, and there is one Mr. B who is an expert in construction. He has all the equipments, he knows the suppliers, he has his own stock of cement, steel, laborers. All those things are available with Mr. B. So Mr. A has land, Mr. B has raw material, machinery, labor and all those parts. Now these two people, they come together and they form a joint venture. What do they form? They form a joint venture to construct apartments. They form a joint venture to construct apartments. The arrangement is such that Mr. A will contribute land, Mr. B will take care of the raw materials, the equipment required for construction, the labor related part. All those things will be taken care by Mr. B. Now when these two come together, there must be some operations carried out for construction of the apartment, right? Now if the arrangement is such that land is still controlled by Mr. A, he is still owning that land, the asset, the other raw material, the other equipment, the other assets are still owned and controlled by B, but the operation of construction or the construction related activity is jointly controlled by A and B. Remember friends, here A and B are controlling only the construction related activity. Maybe how many floors should be constructed, what should be the design of the floor, how many square feet must be constructed, how much open land should be left out, what should be the timeline, what should be the selling price. All these activities related to operations are controlled by A and B. But asset control, the ownership and controlling of the asset is still lying with A and B independently. B does not control the land part of it. A does not control the assets which B is bringing to the joint venture. This kind of arrangement where only operations are controlled jointly is called a jointly controlled operation, right? Now this was about jointly controlled operations, but in the same example, if the asset which has been contributed, say Mr. A contributed land to the joint venture, Mr. B brought in the materials, Mr. B brought in the equipments, if these assets are jointly controlled by both the parties, then it is called jointly controlled asset. Now when we say jointly controlled, a proportion of the control coming from ownership is vested with both the parties, or it could also be worked out slightly differently. A contributes land, B contributes money with the help of which certain assets are required, and this asset pool is jointly owned and controlled by both the parties. In that case, it becomes a jointly controlled asset. I am repeating once again friends, under jointly controlled operations, assets are controlled by the individual parties who are bringing the asset. Only the operations are controlled by both the parties. But if it is a jointly controlled asset, assets which are brought into the joint venture are controlled by both the parties. And the third category, which is a jointly controlled entity, in that scenario what happens is A and B, they come together and they form a new entity, maybe AB Constructions Limited. Now this entity carries out the construction activity, land is transferred to that entity, all the other equipment, materials, that is transferred to that entity. This entity is jointly controlled by A and B, and that entity, that is the AB Construction Limited, that will own all the assets related to the construction. So there can be three different forms: jointly controlled operations, jointly controlled assets, jointly controlled entity. Now it is not necessary that the joint venturers only pass on the property. They can invest money as well. They can contribute money to the joint venture, and that joint venture can purchase asset, or the joint venture entity can purchase the asset, and depending on the kind of the joint venture, control lies with the co-venturers. So it is not always necessary that material is supplied or land is supplied or equipment is supplied. Even money can be passed on or money can be invested in the joint venture, and if it is a jointly controlled entity, that entity will start purchasing asset and that entity will control the asset, but this entity will be jointly controlled by the co-venturers. Now how much control, which areas to control, what is the degree of control, everything will be defined in the agreement, everything will be indicated in the agreement. Having understood what a joint venture is, what are the types of joint ventures, now we will move on and understand what are the accounting related aspects. What is so special about accounting for joint venture? How is it different from our normal accounting? Can't we do a partnership like accounting? If that is the case, why do we need to learn it separately? Friends, joint venture, as we said, is only for a specific purpose, for a specific period of time, and once the purpose is achieved, the joint venture closes down. And the accounting for joint venture is also special because, as we mentioned earlier, in some cases the joint ventures will have a separate entity created. In some other cases it may not have a separate entity created. When a separate entity is created, generally that entity will maintain the books of accounts. But if no separate entity is created, how do we maintain books of accounts? How do we arrive at the profit figures? How do we distribute the profits? How do we keep track of the cash that has come in, the assets and whatever has been purchased? How do we track that? That is what we will understand now. Now, to broadly categorize the accounting treatment, there is one case where books of accounts are maintained separately, either because it's a separate entity or the joint venturers have decided that we will maintain separate set of books of accounts for the joint venture. That is one category. The other category is when separate books of accounts are not maintained. So first we will deal with how do we account for when we maintain separate set of accounts, how are accounting transactions recorded, and then we will move on to the next category. Generally what happens is when there is a joint venture formed, the co-venturers, they may contribute some initial amount to the joint venture. Now, why is this initial amount of contribution required? The amount is required to fund the operations. Maybe the joint venture needs to purchase something. Maybe they need to pay the salaries of the staff. For all the expenses, they will make an initial contribution. Like partners contribute to the capital of a partnership firm. In similar lines, co-venturers will contribute capital by way of cash or by making a payment through bank. That is one way in which the co-venturers would contribute funds to the joint venture, with the help of which the joint venture starts its business. Now, these funds that has been collected, the amount that has been collected is generally pooled or kept in a joint venture bank account or a joint bank account. See, there are two co-venturers, A and B. A brought in 10,000, B brought in 10,000. Now, this 20,000 rupees, in which bank account will you keep? For this purpose, you will open a separate joint bank account, and this 20,000 will be deposited in that joint bank account. Now, look at it from the joint ventures perspective. We are discussing a case where books are maintained separately. Now, look at it from the joint venture perspective. What happened in the joint venture? The joint venture got cash or got in form of a check 20,000 rupees. So, what should be the entry for that? You will debit joint bank account because the amount has come into the joint bank. Joint bank account debit. And whom will you credit? This amount has come from A and B. So, you will say to Mr. A, to Mr. B. Or in other words, when you receive contribution or when you receive cash from the joint venturers, from the co-venturers, the entry will be joint bank account debit to the respective co-venturers account with whatever amount they have contributed. This entry is in line with the fundamental rules of debit and credit. Now, what does that say? You will credit the giver. Who have given the amounts? The co-venturers. So, you have credited the co-venturers, and correspondingly your bank balance has increased, your asset has increased, and you have debited the asset. Other way of looking at it is the co-venturers have contributed money which the joint venture will repay back at a later date. So, a liability is being created, a liability is increasing, and hence you are crediting the co-venturers account. Now, instead of giving cash, if the co-venturers give some form of material or assets, say for example, Mr. A, he deals with the raw material and he has supplied the raw material to the joint venture. In such a scenario, how will you pass the entry? Now friends, whenever a joint venture incurs certain expenditure, you will debit the expenditure to the joint venture account. Like we did in the consignment accounting, all the expenses related to consignment we debited to consignment account, all the incomes related to consignment we credited to the consignment account. Similarly, in the joint venture, whenever there is an expenditure, for example, Mr. A has supplied the raw material. Now that raw material will be used in the production or in the construction activity, which will become an expenditure. So that expenditure will be debited to the joint venture account. It acts as a consolidated nominal account which will capture all the expenses all the income. So whenever Mr. A supplies certain raw materials, you will debit that to the joint venture account. You will credit that to Mr. A, who is the co-venturer. So whenever a co-venturer supplies any material, supplies any assets to the joint venture account, you will debit that item to joint venture and you will credit the corresponding co-venturer account. So joint venture account debit with all the expenses that has been incurred to co-venturer account. Sometimes the co-venturer supply equipment to the joint venture. Now in such a case, whatever the equipment has come in, you will debit the joint venture account and you will give a credit to the co-venturer. And after the venture is over, when that equipment is returned back, you will credit the joint venture account and you will debit the co-venturer to whom the asset has been given back. For example, A transferred asset worth or A transferred equipment worth 10,000 rupees. So what will be the entry in that case? Joint venture account debit 10,000 to Mr. A 10,000. After 1 year, after considering depreciation, the co-venturers agreed that this asset or this equipment is now worth only 8,000 and this has to be given back to Mr. A. In that case, you will credit the joint venture account by 8,000, you will debit Mr. A's account by 8,000. Now if you look at the net impact, 10,000 was debited, 8,000 was credited to the joint venture account, the net impact is 2,000, which is nothing but the depreciation. Or alternatively, you can create a separate fixed asset account and charge only the depreciation related part to the joint venture. Even that is possible. Now after the initial contribution by the co-venturers, the joint venture has cash with it. It may go out and purchase certain items, it may go out and purchase raw materials, it may go out and purchase equipment, and whenever it does those transactions, you will debit the joint venture account with all the expenses that are being incurred and you will credit the joint bank account. So whenever an expenditure is being incurred, whenever an equipment is being purchased, this is how you will pass the entry: joint venture account debit to joint bank account. Now after carrying out the operations, after the finished products are available or after the construction activity is completed, those units will be sold to third parties. Now whenever there is a sale that is happening, it is an income for the joint venture. If it is an income, you will credit the joint venture account and you will debit either the joint bank account if it is a cash sale, or you will debit the trade receivables account if it is a credit sale. So what will be the entry in that case? Cash account debit or joint bank account debit or trade receivables account debit to joint venture account. If you look at this joint venture account, on one side you can see all the expenses, on the other side you can see all the income. Now whatever is the difference, if income is more than the expenditure, there is a profit. If expenditure is more than the income, there is a loss. Now whatever is this profit or loss, that will be transferred to the co-venturers account in their profit sharing ratio as driven by the agreement. Now this is a brief of how do we pass the entries when there are separate books of accounts maintained. From your exam point of view, if they ask you a question, prepare necessary accounts in the books of joint venture, there are three important accounts that you need to prepare. The first one is joint bank account, the second one is joint venture account, and the third one is co-venturers account. If you prepare these three accounts, it will be sufficient for your examination point of view. Of course, when you go to the real life, you may need to prepare a separate fixed asset account. There could be trade receivables, there could be trade payables, a lot of other accounts would be involved. But if the examination asks you, these are the three important accounts that you need to maintain. If required in some cases, you may need to prepare some more accounts, but that completely depends on the question. Let us now have a look at an illustration and understand how do we account the transactions when separate set of books are maintained. B and C enter a joint venture to prepare a film for the government. Oh, now they are in the business of filmmaking. The government agrees to pay rupees 1 lakh. So government agrees to pay how much? Rupees 1 lakh. That will be the net sale consideration, or that will be the sale proceeds. B contributes 10,000 and C contributes 15,000. So to start the business or to start the joint venture, B has contributed 10,000, C has contributed 15,000. These amounts are paid into a joint bank account. So as we discussed earlier, they have created a separate joint bank account in which this 10,000 and 15,000 has been paid. Payments made out of the joint bank account where? So out of the joint bank account, they have made certain payments. Purchase of equipment 6,000, hire of equipment 5,000, wages 45,000, materials 10,000, other office expenses 5,000. B paid 2,000 as licensing fees. On completion, the film was found defective and the government deducted 10,000. So earlier the sale consideration was 1 lakh and now the government has deducted 10,000. The equipment was taken over by C at a valuation of 2,000 rupees. Separate books were maintained for the joint venture whose profits were divided in the ratio of 2/5 and 3/5. So like you would have seen in the partnership accounting, here also we have a profit sharing ratio. Give necessary ledger accounts. So when generally the requirement is to prepare necessary ledger accounts, you just need to prepare 3 ledger accounts. So quickly draw up in your notebook: 1, the joint venture account; 2, the joint bank account; and 3, the co-venturers account. This co-venturers account you can prepare in a combined table or you can prepare separately. For now I am preparing separate account for B and separate account for C, but in your examination, to save time, you can prepare multi-column co-venturers account. Means in the same account you can have a column for B and in the same account you can have a column for C. Now let us start posting the transaction in the respective ledgers. Now when we are posting the transaction, we will also look at how the journal entry looks like. That becomes a practice for you in case the questions in the examination asks you to prepare the journal entries as well. If you look at the illustration, it says they have entered into a joint agreement or a joint venture. The government agrees to pay. So far you have not received the payment, so that entry will not happen now. B contributes 10,000 and C contributes 15,000. Now we have not been given dates, so we will prepare ledger accounts without dates. In case dates are given, you add one more column for date and post the entry on the respective date. When Mr. B contributed 10,000 and when Mr. C contributed 15,000, where did the money come to? The money came into the joint bank account of the joint venture. So you will debit the joint bank account. So the entry will be joint bank account debit to B's account. How much did B contribute? B contributed 10,000. All the amounts are in rupees. I'll just mention that in rupees. Right? And to C's account 15,000. So B's account 10,000 to C's account 15,000. What is the journal entry? Joint bank account debit 25,000 to B's account 10,000 to C's account 15,000, being initial contribution received from the co-venturers. These two entries will have a corresponding impact in B's account and C's account. So in B's account you will say by joint bank account 10,000 and in C's account you will say by joint bank account 15,000. Doesn't it look like an initial capital contribution entry? It exactly looks like that. Read further. These amounts were paid to the joint bank account and payments were made out of the joint bank account as below: purchase of equipment, hire of equipment, wages, materials, office expenses. All these are outflows from the joint bank account. And friends, we have understood that all the expenses of the joint venture will be debited to the joint venture account. Now in this list, equipment is not an expense, it is actually an asset which will be expended or which will be charged to the joint venture account in form of a depreciation. So the way to do that is debit joint venture account with the entire amount. Later when that equipment is sold or when some value is realized, we'll credit that to the joint venture account. So whatever is going out will debit the expenses to joint venture account and credit will happen to joint bank account. So let's pass that entry by joint venture account. Why joint venture account? This is a single consolidated account which will capture all the expenses. We will not say by hiring charges or by office expenses. Simple entry, a single entry by joint venture account. What is the first item? Purchase of equipment 6,000. Then hire of equipment. Hire of equipment is nothing but rent paid towards hiring of an equipment, that is 5,000. Wages 45,000. Then we have materials 10,000, and then we have office expenses. How much? 5,000. So these are the outflows from the joint bank account. Now you may ask, sir, how can outflow be more than inflow? Friends, there is a concept of overdraft as well. Maybe the bank has allowed us overdraft. Now these expenses will have to be debited to the joint venture account. The corresponding impact, here we have credited the joint bank account, the corresponding debit will happen to the joint venture account. So come to the joint venture account, there you will debit the joint venture account with all these expenses. So in the joint venture account, to joint bank account. Now you may consolidate all the amounts and pass a single entry, but for better presentation, write it item by item. So first we have purchase of equipment 6,000. Then we have hire of equipment 5,000. Then we have wages. How much is the wages? 45,000. Then materials of 10,000, and lastly we have office expenses of 5,000. So these are the expenses to be debited to joint venture account. Now for all the expenditure that we have posted through joint bank account, you need not pass separate entries in journal. You can simply say joint venture account debit to joint bank account and total the expenditure 6 plus 5 11, 11 plus 45 56 plus 10 66 plus 5 71. The 71,000 you can pass it using a single journal entry. Are these the only expenses? Is there any other expenditure? Let us read further. It says B paid 2,000 as license fees. Who paid the license fees? B paid the license fees. Is it an expenditure for the joint venture? Yes. So what will you do? You will debit the joint venture account. But what will you credit? Will you credit the joint bank account? You will not credit the joint bank account because the venture or the amount has not been paid through joint bank. B has paid the amount. This amount is payable to B now, or the joint venture must reimburse this amount to B. So that means we have to create a liability towards B. We have to credit B's account. Debit joint venture account, credit B's account. Let us pass that entry. To B's account 2,000, in the bracket you can say license fees. Anything else? Are there any other expenditure? No, there are no other expenditure, but this whatever we have debited in the joint venture account, that is joint venture account to B's account, will have a corresponding impact in B's account. So come to B's account, here you can say by joint venture account, that is towards license fees 2,000 rupees. This is what is payable to B. Now friends, after you have passed the expenses, what is the revenue? The revenue was agreed at 1 lakh, but how much was received? The government deducted 10,000, we received only 90,000, which means amount that has been received 90,000, where will it go? It will go to the joint bank account. You will debit joint bank, and what will you credit? The nominal account which is created for ascertaining the profit or loss, the joint venture account, we will credit that account. Instead of crediting sales, we will credit the joint venture account. Friends, if you observe, the logic of passing entries in consignment and joint venture are similar. A single account capturing all the expenses and all the income. So how much is received? 90,000. So come to the joint venture account by joint bank account 90,000. Now this receipt amount will also be posted in the joint bank account. And what is the entry for that? As we have already discussed, joint bank account debit to joint venture account being amount received from the government towards completion of the film. So in the joint bank account we will have to joint venture account. In the bracket you can write sales amount is 90,000. Now, is there anything left out? Friends, the joint venture purchased an equipment for 6,000 and it was transferred to whom? It was transferred to C at a value of 2,000, which means though the joint venture had paid 6,000, 2,000 will be recovered from C and the net impact on the joint venture account should only be 4,000. This, as I said earlier, could be dealt by creating a separate equipment account where you say equipment account debit to joint bank account 6,000. Then you can credit the equipment account by saying by C, equipment transfer to C 2,000 and net amount 4,000 can be transferred to joint venture account. That is one approach. But to keep it simple, not to create too many accounts, we will transfer that through joint venture account. Come to the joint venture account. This equipment 6,000 is transferred to C at a valuation of 2,000, which means there is an inflow from C, or it is as if C is paying 2,000 to take over this equipment. So we will credit that amount to the joint venture account. We will debit it to C because C is the receiver. So the entry will be by C's account equipment transferred. C's account equipment transferred. How much is the amount? 2,000. We have captured all the incomes, we have captured all the expenses. Now let us close the joint venture account to ascertain what is the profit or loss, and that profit or loss will be transferred to the co-venturer's account. So now if you look at the joint venture account, on the credit side you have 92,000 minus 6,000 on the debit side, minus 5,000, minus 45,000, minus 10,000, minus 5,000, minus 2,000. So you get a net profit of 19,000. The credit side is more than the debit side by 19,000. There is a profit of 19,000. And what happens to this profit? This profit will be transferred to B's account and C's account. In which ratio? In their profit sharing ratio. So 2/5 of 19,000 will go to B, 3/5 of 19,000 will go to C. So let us pass that entry. To B's account profit 2/5 of 19,000 and to C's account, that is profit, how much is that? That will be 3/5 of 19,000. Now how much is 2/5 of 19,000? 2 by 5 of 19,000 is 7,600. So this is 7,600 and 3/5 of 19,000 is 11,400. Now these two profits you can put it in the inner column and then put the total 19,000 in outer column. It is just a presentation different, that does not matter much. Let us close this account, which is 92,000 here and 92,000 here. This is the profit that has been transferred to the respective co-venturers account, right? So let us go to the co-venturers account and post this profits. By joint venture account for profit. How much was the profit? 7,600. And come to C's account. By joint venture account, again here there is a profit, and how much was that profit? 11,400. Friends, C had also taken the equipment which we had credited to the joint venture account, that will be debited to C's account. So the entry for that will be C's account to joint venture account equipment transferred 2,000 rupees. Now we have debited and credited the joint venturers account with the respective amounts. We will find out what is the amount payable or receivable from each of those co-venturers. So first let us have a look at B's account. If you look at B's account, you have 10,000 on the credit side plus 2,000 for the license fees, 7,600, that is towards the profit. 19,600 is payable to B. So what will you say? B's account debit, because you will pay the amount to B. to joint bank account. Friends, as we have discussed, joint venture is for a specific purpose. After the completion of the purpose, after the achieving of the objective, the joint venture will be closed, and because it is being closed, the accounts will also be settled, right? So this is nothing but the balancing figure of 19,600. Come to C's account. On the credit side, you have 15,000 plus 11,400, that is 26,400 minus 2,000, which is 24,400. So, to joint bank balancing figure, how much was that? 24,400. 24,400. Now, these amounts will have a corresponding impact in the joint bank account. Here you said B's account debit to joint bank account, C's account debit to joint bank account. That is nothing but the final settlement amount. So, corresponding impact, the next leg of the entry will appear in the joint bank account. So, come to joint bank account. Here you have paid, right? So, by B's account, which is the final settlement. How much was that? 19,600. And by, similarly we have settled C's account also, by C's account final settlement, which is 24,400. Now this is how you would have paid out to the co-venturers. Now friends, these co-venturers put in some amount, the joint venture incurred certain expenditure, they earned certain amount, they distributed the profits, the joint venturers or the co-venturers account have been settled. Ideally, there should not be any balance left out in the bank account, because whatever has been received has been either spent or has been distributed as profits, right? So let us see if there is anything left out in this joint bank account. So if you look at the debit side, you have 10,000 plus 15,000, 25,000 plus 90,000. That makes it 1,15,000. That is on the debit side. On the credit side, how much we have? 6,000 plus 5,000 plus 45,000 plus 15,000 plus 19,600 plus 24,400. So this also gives us 1,15,000. So nothing is left in the bank now. 1,15,000. So with this, the bank account is also closed. I hope the manner to account for the basic joint venture transactions where separate set of books are maintained is clear. Let us now have a look at one more illustration. Rajiv and Sanjeev enter into a joint venture as dealers in land, and they opened a joint bank account with 75,000 rupees, towards which Rajiv contributed 50,000. So total contribution to the bank account is 75,000. Rajiv has contributed 50,000, which means Sanjeev has contributed balance 25,000. They agree to share the profits and losses in proportion to their cash contribution. So what is the cash contribution? 50,000 and 25,000. So if the cash contribution is 50,000 and 25,000, their profit sharing ratio is 50,000 is to 25,000, or this is 50 is to 25. We will simplify it further when we do the solution. They purchased a plot of land measuring 5,000 square yards for 50,000 rupees. So 5,000 square yards were purchased for total amount of 50,000. It was decided to sell the land in smaller plots, and a plan got prepared at a cost of 5,700. So a large plot was purchased, and then they prepared a plan, means they divided the larger plot into smaller plots. To prepare the plan, how much was spent? 5,700. In the said plan, 1/5 of the total area of the land was left over for public roads, and the remaining land was divided into 8 plots of equal size. Now this question has some interesting other information as well. 5,000 square yards were purchased, 1/5 was left aside, means out of 5,000, 1/5, that is 5,000 into 1 divided by 5, which is 1,000, this was left for public roads. How much is left with the joint venture? 4,000 square yards. Now this 4,000 square yards were divided into 8 plots of equal size. So 4,000 divided by 8, each plot size is 500 square yards. Out of 8 plots, 3 plots were sold at 15 per square yard and the remaining 5 plots were sold at 20 per square yard. So each plot size is how much? Each plot size as we computed is 500 square yard. Some were sold for 15 per square yard, some were sold for 20 per square yard. Expenses incurred in connection with the plots were registration expenses 6,000, stamp duty 600, other expenses 2,500, and the question also says allow 5% of the sale proceeds as commission to Rajiv. So a lot of information around the transaction. So we'll need to prepare some working notes, and then the question says journalize the above transaction and prepare necessary ledger accounts. Friends, whenever the question says prepare the ledger accounts and write the journal entries, normally it is advisable to first prepare the ledger accounts. As and when you prepare the ledger accounts, immediately write those journal entries, because once you prepare the ledger accounts, writing journal entries is easier, right? With this background, let us start solving the problem. Now in this problem, before we start solving or preparing the ledger accounts, we'll need to do some working notes to find out what is the profit ratio, then find out how much is the sale proceeds and what is the commission amount. After preparing these 3 working notes, we can directly start preparing the ledger account. So first we will find out what is the profit sharing ratio. In the question it says profit sharing is done in the ratio of cash contributed. So how much is the cash contributed? So let's prepare working note 1 for arriving at profit sharing ratio. Profit sharing ratio. How much is cash contributed? Total cash contributed is rupees how much? 75,000. How much was contributed by Rajiv? The question says contribution by Rajiv. What is the contribution by Rajiv? Rupees 50,000, and whatever is the balance. What is the balance? Balance contribution by Sanjeev. How much is the balance? Rupees 25,000. Now, what is the profit sharing ratio? The profit sharing ratio is 50 and 25. So, between Rajiv and Sanjeev, it is 50:25. We can simplify it further as well. So, 5 goes 10 times, 5 goes 5 times, and 5 goes 1 time, 5 goes 2 times. So, it is 2:1. This is the profit sharing ratio. The second working note we need to prepare is what is the area of the plot that will be sold. Now it is we already did when we did the question, but let us present it in a fair manner as a part of working note. Working note number 2 for sales. Now to find out sales, we need to find out how many plots were created, what is the area of the plot, and then what was the rate at which they were sold. Now the question says total land which was purchased is 5,000 square yards. 5,000 square yards. Out of this, how much was left out for public roads? 1/5. So less public roads, which is nothing but 1/5 of 5,000. How much is 1/5 of 5,000? 5,000 divided by 5, that is 1,000. So 1,000 square yards were left out for public roads. What is the balance left out? Saleable land. How much is that? 5,000 minus 1,000, because what is there for public roads you cannot sell that. So 5,000 by 1 minus 1,000, 4,000 square yards. These were converted into 8 plots. So total number of plots is 8. Area per plot, that is how much will be the area per plot? 4,000 divided by 8, which is 500 square yards. So each plot is of the area 500 square yards. Now what is the sale value? The question says 3 were sold at 15 rupees per square yard and 5 were sold at 20 rupees per square yard. So what is the sale value? Total sales, if you have to compute the total sales, First category 3 into 500 into how much? 15, that is equal to rupees 22,500. And the second category, which is 5 into 500 into 20, 5 5s are 25, 25 into 20 is 50, which is rupees 50,000. So the total sales comes to rupees 72,500. This is the total sales value. Now on this total sales, who is entitled to the commission? Rajiv is entitled to 5% commission. Now with this information, we can start preparing the joint bank account, the joint venture account and respective co-venturers account. Let us now start preparing the ledger accounts and also passing those journal entries. Now the question begins by saying they entered into a joint venture and contributed 75,000 into the bank account. Rajiv contributed 50 and balance was contributed by Sanjeev. So what will be the first entry? Joint bank account debit to whom? To Rajiv account 50,000 to Sanjeev's account 25,000. This is the first entry. And what will be the journal entry? Simple. Joint bank account debit to Rajiv account 50,000 to Sanjeev's account 25,000, and joint bank account will be debited with 75,000. Now these entries we have to post it in both Rajiv's account as well as Sanjeev's account. So in Rajiv's account we say by joint bank account 50,000, and in Sanjeev's account we can write by joint bank account 25,000. Very simple, the first entry. Then profit and losses, we have computed what is the ratio. They purchased a plot of land measuring 5,000 square yards for 50,000. What is this? This will be considered as an expenditure for the joint venture. So joint venture account debited to joint bank account 50,000. So let us pass that entry. Joint venture account debited to joint bank account purchase of land. And how much is the amount? 50,000 rupees is the amount. 50,000 rupees is the amount. Now this particular entry to joint bank account 50,000 will have a corresponding impact in the joint bank account as well. So go to the joint bank account, and what will be the entry here? By joint venture account purchase of land 50,000. And what is the journal entry for that? Joint venture account debit to joint bank account credit 50,000, 50,000 being purchase of land for the joint venture. Now if you read further, it says they got a plan prepared for 5,700 and it has not been mentioned who has paid the amount. So we can safely assume that the amount was paid through the joint bank account. So again in the joint venture account you can say to joint bank account. What was this? Preparation of plan 5,700. What is the journal entry for this? Joint venture account debit to joint bank account 5,700 being expenditure incurred on preparation of a plan. Now this entry will have a corresponding impact in the joint bank account, so post it there. Come to the joint bank account. By joint venture account preparation of plan, which is 5,700. Okay. As you read further, it was divided into equal slices of 8 plots after leaving out 1/5 for the public roads, and they sold it for 15 per square yard. How many plots? 3 plots. 20 per square yards. How many plots? 5 plots. So what was the total sales value? We have already computed it as a part of our working note number 2. So the total sale value we found out was 72,500. Now when the sale is made, what will you credit? You will say to joint venture account. You will credit the joint venture account by 72,500. You will debit the joint bank account by 72,500. Friends, in some cases if there is a credit sale, you will not directly debit that to the joint bank account. first you will debit it to the trade receivables account, and then once money is received, you will debit that to joint bank account. So what is the entry here? Joint bank account debit 72,500 to joint venture account 72,500 being amount received on sale of plots. Come to the joint bank account. How will you post the entry? You will say to joint venture account, which is your sales, 72,500, and in the joint venture account you will write by joint bank, which is your sales, 72,500. And there were some other expenses incurred. Registration expenses 6,000, stamp duties 600, other expenses 2,500. These all are the expenses pertaining to the joint venture. How will you pass that? You will debit the joint venture account. So, to joint bank account, what is the first expenditure given? Registration expenses 6,000. Then you have stamp duty. What is the stamp duty? 600. And then you have other expenses, and other expenses is 2,500. So what is the journal entry here? Joint venture account debited, because all the expenses you will debit it to the joint venture account. Joint venture account debited to joint bank account. And what is the total of expenditure? 6,000 plus 600, 6,600 plus 2,500, that is 9,100. So joint venture account debited 9,100 to joint bank account 9,100 being various expenses incurred in connection to sale of plot. So that will be the journal entry. This particular entry relating to the expenses will also be posted in the joint bank account on the credit side, because this represents an outflow of money. This represents outflow of money. So in the joint bank account you can say by joint venture account. Firstly, you incurred expenses on registration. So registration expenses. How much was the amount? 6,000. Stamp duty 600. And other expenses. How much was the other expenses? 2,500. These are the expenses incurred in connection to the sale. Allow 5% on the sale proceeds as commission to Rajiv. Now, what does this mean? This means that whatever has been collected in terms of sales, 5% is payable to Rajiv as commission. Now, is this commission an expenditure for the joint venture? Yes. So what will you do? You will debit the joint venture account. Whom will you credit? Will you credit bank? No, because we are not paying the money out. Then whom will you credit? You will credit Rajiv's account, because this commission is payable to Rajiv. You are creating a liability, you are creating a payable. So you will credit that to Rajiv account. So the entry will be joint venture account debit to Rajiv's account being commission payable. How much is the amount? 5% of 72,500. How much? 5% of 72,500, which comes to 3,625. So that will be the amount by which you will pass this entry. So let us pass that entry. So in the joint venture account, you will say joint venture account debited to whom? To Rajiv's account for commission. What is this commission? 5% on 72,500. Friends, it is very important in the examination that you write the basis on which you have arrived the amount. Now this 5% on 72,500 is not an implied number you have computed. So in the brackets you must definitely mention how you have arrived at the commission numbers. And what is the value for that? 3,625. 3,625. This commission amount of 3,625 must be credited to Rajiv's account. So go to Rajiv's account by joint venture account commission 3,625. Now I think we are done with all the entries. With this, we can compute what is the profit or loss on account of joint venture. Let us do that. So coming to the joint venture account, we have 72,500 on the credit side minus 50,000 of expenses on purchase of land minus 5,700 on preparation of plan minus 6,000 minus 600 minus 2,500 minus 3,625. So the profit comes to 4,075. That is the profit. Now this 4,075 will be distributed in the ratio of 2:1. So how much will Rajiv get? How much will Sanjeev get? Rajiv will get 2 out of 3 because the ratio is 2:1. So let me do a brief computation as a working note for your better understanding. So the total profit which is earned is 4,075. 2 parts goes to Rajiv, 1 part goes to Sanjeev. The profit sharing ratio of 2:1 means out of 3 parts, 2 parts will go to Rajiv. So out of 4,075, 2/3 goes to Rajiv. So 4,075 into 2 divided by 3 gives us 2716.66. I will round it off to 2717. So Rajiv gets 2717. And how much will Sanjeev get? Sanjeev will get 1358. Sanjeev gets 1358. This will be transferred to their respective co-venturers account. Come to the joint venture account. In the joint venture account, you can pass these entries. So, to Rajiv account profit share as per working note number 1, to Sanjeev account profit share. How much goes to Sanjeev? Sanjeev gets 1358. And how much goes to Rajiv? Rajiv gets 2717. This is as per working note number 1. This is as per working note number 1. With this, we have closed the joint ventures account. We have closed the joint venture account. Now this 2717 and 1358 will be credited to the respective co-venturers account. In Rajiv's account, you will write by joint venture account. What is the amount? 2717. Now because there is already an entry called by joint venture, you can actually club it with this entry. So by joint venture share of profit 2717, or you can separately write by joint venture account share of profit 2717. And how much goes to Sanjeev? By joint venture share of profit. How much goes to Sanjeev? 1358 or 1358. After this, we can close this co-venturers account. Now, if you look at Sanjeev's account, there are 2 credit items, 25,000 and 1358, which has to be repaid back or which is repayable to Sanjeev. Now, let us look at the journal entry for sharing of these profits. What did we do? We debited the joint venture account. So, joint venture account debit to Rajiv's account to Sanjeev's account with the respective amounts, right? So this will be the journal entry for sharing of profits. Now after we have shared the profits, now we can go ahead and close the co-venturers account. If you open Rajiv's account, what are the credits? 50,000, 3625, 2717. So let us total that up. 2717 plus 3625 plus 50,000 gives us 56,342. This will be paid to Rajiv. So to joint bank balancing figure, to joint bank balancing figure 56,342. What will be the journal entry for this? Rajiv's account debit 56,342 to joint bank account 56,342 being final settlement made to Rajiv. Similarly, we can do the final settlement to Sanjeev. Come to Sanjeev's account, 25,000 and 1358, which means 26,358. So this is the amount that will go to Sanjeev. So to joint bank account balancing figure 26,358. What will be the journal entry for this? Sanjeev's account debit to 26,358 to joint bank account 26,358 being balancing figure or being the balance amount paid to Sanjeev. 26,342 and 26,358 that will be credited to the joint bank account. And what will be the entry for that? In joint bank account you can say by Rajiv's account 56,342 and by Sanjeev's account 26,358. Now like in the earlier problem, the total of both sides would tally and there will be no balance left in the bank account. Let us cross check that for our comfort. So on the debit side you see 50,000 and 25,000, 75,000 plus 72,500. So 75,000 plus 72,500 gives you 1,47,500. So you have 1,47,500 on the debit side, and on the credit side you have 50,000 plus 5,700, which is 55,700. 55,700 plus you have 6,000 plus 600 plus 2,500 plus 56,342 and 26,358. The total comes to 1,47,500. So this balances the bank account. This is how you will prepare ledger accounts when separate books are maintained by the joint venture. And journal entries after you prepare the ledger account is very simple. Just by looking at the ledger, you can pass those journal entries.